Welcome to the ISG's quarterly call summarizing the first quarter of 2018. My name is Howard Coleman, and I'm the Chief Investment Officer of Coldstream. And with me today is Brander Richmond, the Portfolio Manager for Mark Pellegrino's team. I'll be providing the market recap this quarter, and Brander will present our special topic, which I think is top of mind for many of you, and that is the impact of tariffs on markets. There's a box on your screen where you can type in any questions you might have. We'll try to address questions today, but we may not get to them. If we don't, please contact your RM, your relationship manager, or your portfolio manager with your questions. We scheduled this call for 30 minutes. However, please bear with us if we run over by 10 to 15 minutes because it's an interesting topic and we want to make sure we cover it thoroughly for you. Thank you again for attending. Now I'll commence the market recap. 2017 was a very strong year in markets. The S&P was up 22%, the NASDAQ was up 30%, and emerging markets were up 37%. Very strong year. This chart gives you a look at what happened since 2017. And as you can see, there's been some significant changes from the middle of January. In the beginning of the year, we really had an extension and even an acceleration of the bull market of 2017, with for the S&P, for example, up 7.55%. Emerging markets continuing their strong run, up 9.93%. Really, the only thing that lost money in the first quarter were things that were sensitive to rising rates. The Barclay Aggregate Bond Index, the U.S. investment grade bond. This is, as of the 26th. And then REITs were down 287. Things began to reverse significantly on 126, and we had significant volatility in the markets, which was really the story of the first quarter. You can see between the 26th and the end of the quarter, we had some significant declines with the U.S. large cap down almost 2%, the Barclays Aggregate Bond Index, which is treasuries and high quality corporate paper, down 146, and emerging markets going from up 654 to down, up 993 to up 128. And year to date, the volatility trend has continued. And you can see the numbers on the far right-hand corner of where we are as of May 2nd. Now, the thing that I find most interesting about this is what is considered the safest assets. Barclays Aggregate Bond Index, which, as I mentioned, is treasuries and U.S. investment grade, that is considered the safest in the fixed income world. The safest or the less volatile in the equity world is the Dow Jones Industrial Average, and that was down the most of any equity indices besides the REITs, which was down 260. So you had the safest assets getting hit the hardest year to date. And really the reason for that on the bond side has been that interest rates have continued to rise. And on the equity side, some of the largest cap stocks, the industrials, et cetera, have gotten hit the hardest. Now, I want to show you some charts of these indices, some of the indices, and it's interesting because you'll see that they show a common pattern, and the pattern is actually, I think, somewhat bullish, although we'll see as time progresses. The red line you see on these charts is the important one I want to focus on, and that's the 200-day moving average. That's the average price of this index over the last 200 days. It is a well-known technical indicator, and although it has no fundamental meaning, the market pays attention to these technicals. It's the magic of the markets. So they pay attention to these technicals, and things often bounce off that. If they don't bounce off it, then you can expect some more significant declines. And see how in U.S. large cap, we bounced off that 200-day moving average. We seem to be testing it again a little bit, but today, for example, was an up day, and we seem to be keeping away from it again. As you see in U.S. SMID, we've bounced off it twice recently and 3 times in the recent past. In international developed, we hit the 200-day, we've bounced off it. Emerging markets, we've now hit that 200-day, and it appears we are bouncing off it as well. You have to keep your fingers crossed that we continue to bounce off it. And again, this is a technical indicator, no relation to fundamentals, but the market seems to pay attention to this. And the fact that we haven't gone through that significantly so far is a decent sign, but stay tuned. Now, what is the significant theme of the first quarter? If I had to characterize that theme, it's volatility. This chart shows 2% daily changes in the S&P, and the dotted line, the horizontal line there, the vertical line there, shows the end of 2017 and the beginning of 2018. And you can see in 2017, we did not have a 2% daily change. And if I could go back in history, you would not see a chart like this. The muted volatility in 2017 was historically unprecedented. 2018 is a very different story. We've had significant volatility in the markets since that time. Now, of course, we've had much higher volatility in other times, for example, 2008 and 2001, but the change from the volatility in 2017 to the volatility this year is significant. So the question is, why have we had this volatility? And I'm going to talk about that for a moment. Really, there's been 4 factors, and they are more macro factors than factors that have to do with the markets. The first and the most important is trade policy, and I'm not going to address that today. Brander is going to address that, and we're devoting a full topic to that because we think it is important to discuss. The second is the action of central banks. The third is inflation concerns, and the fourth is the significant budget deficit, which I think is probably the least important for the immediate volatility, but does play a factor. I'm going to discuss each one of these in turn right now. So let's talk about central banks. Starting at the end of 2008, I think most of us know that the central banks began buying bonds in markets. The red here is the Federal Reserve, the yellow is the Bank of Japan, the blue is the European Central Bank. And we've seen since 2018 that they are actively in the market buying bonds. This keeps yields low, and it provides liquidity to the markets generally. What's changing now is that the Federal Reserve is no longer buying, and it is anticipated, and the European Central Bank has announced, the ECB has announced that they will significantly reduce bond buying in the fourth quarter. And we can see that this really artificial support for the markets is beginning to end. The second thing that's happening in the central bank world is the flattening yield curve. And the flattening yield curve is in large part caused by what's called the rise in the front end. And if you look at the left of your screen, and you can see these are 1-month treasury rates. And the Federal Reserve sets interest rates for overnight lending, and those interest rates have a direct impact on the 1-month treasury. The Fed has been raising rates and is going to continue to raise rates over the next 3 or 4 quarters. We don't know whether it's going to be 2 rates or 3 rates this year. That's a debate in the markets, but we know with relative certainty that they are going to raise rates. And so the front end has been rising. The back end, the 10-year and the 30-year, have more to do with the market's projections of growth and inflation than they do on what the Federal Reserve is going to be, and the relatively tepid predictions for what growth and inflation are going to be as reflected in these yields. So we see that if you own a 2-year bond versus a 30-year bond, you're really not earning a lot more interest for 2 years than you are for the risk of 30 years on an annual basis, which is a bit unusual. It's something we're keeping an eye on. An inverted yield curve has historically been an indicator of recession. We don't think the curve's going to invert, and certainly we don't see a recession in sight, but it is something to pay attention to, and it is something the market is watching. The third issue is inflation, and we really haven't seen a lot of inflation reflected yet, but on the left-hand chart here is the unemployment rate, and we can see that the unemployment rate has fallen significantly, and it is now below 4%. That is The last time it was below 4% was for 3 periods in 2001, and it's been a long time before that where it was that low again. Typically and historically, that kind of low employment rate results in wage pressure because simply the laws of supply and demand have to offer more money to get the people to work for you when there's not a lot of people who are unemployed. We've seen some wage pressure recently, but this has been a surprise to the market that with this significant increase in employment, we've seen some increases in wages, but not that significant. Inflation, wages are a big part of inflation, but there's other parts of inflation, and goods inflation is one, and we've had what's been known as the Amazon effect, where Amazon has put pressure on goods prices, and this has in some ways helped to keep inflation under control, but the forecasts are for rising inflation. Excuse me. The final issue is the deficit. And we have had a significant tax cut recently, and we have had a budget that has significant deficits. This is unusual in the markets for the sense that usually stimulative measures like tax cuts and significant budget deficits occur during periods of recession as a way of stimulating the economy. We are not in recession, we are growing, but we are significantly increasing the budget. And this is a chart of federal debt held by the public, which is virtually all federal debt. And we can see that it has now grown to about 80% of GDP. Japan, for example, was much higher, but as you can see, this has been higher really since any period since the end of since we were coming out of World War II. And the budget deficit itself is significant. We can see right here in this chart, and this is in billions of dollars. For fiscal year 2019, because of the tax cuts and because of the budget, we're looking at $1 trillion budget deficit. When we include the fact that some of our debt is rolling off, the government's going to have $3 trillion of financing needs next year, which plays very much into the question of who is going to buy that debt and how that debt will be absorbed in the market. And this relates very much to some of the issues that Brander is going to cover in the trade war, as China is in a potential trade war, as China is a significant purchaser of US debt. Now, I've been painting a pretty gloomy and nervous relating picture. However, we see the fundamentals of the economy as extraordinarily strong. We have strong supply side fundamentals, we have strong demand side fundamentals, we have strong earnings, and we have strong valuations. In terms of demand side, in terms of supply side, this is the Purchaser Managers Index. This is an indication of whether the industrial economy is growing or shrinking. And here we can see in the right-hand column in the green, everything is green except India, which is yellow. Now the trigger point for green is 50, and which it means growing, and India is 49.7. So we have a universally green screen here, very bullish. We're in the 7th percentile of historical macroeconomic volatility. In other words, 93% of the time, macroeconomic volatility is higher than it is now. We've got 94% countries with growing economies, and we have 60% of countries not only growing, but accelerating. And this is remarkable. We are in a period of synchronized global growth. In the US, the blue line is the leading economic indicators. They predict what's going to happen going forward. The red line is the coincident economic indicators. They reflect where we are now. And as you can see, the shaded lines earlier are recessions. We don't go into a recession historically until about 6 months after the leading economic indicators roll over, and we are nowhere near the economic indicators rolling over right now. We do not see a recession in sight. Consumer sentiment is strong on the supply side. People are optimistic. And corporate earnings may be the strongest. Talked about the negative of the tax cuts regarding potential budget deficits. Here's one of the benefits of the tax cuts. Corporate earnings, 11.1% growth in the first quarter of this year, and we have not seen the full effect of them yet. You can see they are projected to grow even stronger. So corporate earnings are also a wind at the economy's back. And valuations, because the market has come off, are now at the historical average. If you've been listening to these calls over the last year or so, we've been talking about valuations being stretched. They really aren't anymore. They are average valuations in the S&P index. So what we have now is we have a period of very strong fundamentals with macroeconomic jitters. In terms of where we are and how we believe markets will trend, we think fundamentals govern, and we're confident, although we do have some concern about the macro and economic factors. Now I'm going to turn the session over to Brander, who's going to talk about our special topic.
Thank you, Howard. I'm really excited to present the special topic regarding tariffs and their impact on the market today. It is really our intention with this presentation to focus on the potential impact of trade policy on economic fundamentals as well as the market, and really not express any political views. We live in a relatively polarized and politicized environment today, and it is our intention to not give any type of political opinion in today's presentation. With that said, I'd like to jump in and show you what topics I'd like to cover today. So I'd first like to start with just a general refresh course on what type of trade barriers countries can implement. And then I transition to a brief history of how the US has utilized tariffs in the past. We'll then look at the last couple of decades in terms of the trend of trade globalization, and then fast forward to today and take a look at what tariffs are currently being proposed, how those tariffs have impacted the market so far this year, what are the risks in terms of global trade and growth? Why is the US so focused on China? And then end the presentation by talking about what areas within Coldstream's portfolios may be less likely affected by escalating protectionist policies. So I'd first like to start off by just talking about what type of trade barriers countries can implement. And probably the most known and the most important is a tariff. And a tariff is effectively a tax imposed on goods and services being imported into the country. And there's a couple of different types of tariffs. There's a fixed fee tariff, which can mean that a nominal fee, like a $15 fee, would be assigned to any good that's being imported into the country. And there's also another type of tariff called an ad valorem tariff. And this is what we've seen more recently in the news. This basically takes a percentage of the value of the good and tacks on a tax at that percentage. Other types of trade barriers that are implemented are quotas. They restrict the amount of a particular good that can be imported, and this ultimately reduces the supply of those goods. We also have licenses, which are only granted to specific businesses to import in certain types of goods. So what is the main reason cited by countries when they're implementing trade barriers? Well, the number one reason, and most often the most politicized reason, is protecting domestic jobs. Increased competition can threaten domestic producers, and that ultimately may lead to them laying off workers domestically and having to shift those resources abroad to compete. Another reason brought up is national security. Countries are looking to protect certain industries that are assessed as strategically important in supporting state interests to maintain national security. Another reason brought up, which mostly affects developing nations, is that they may implement trade barriers to protect new nascent industries that may not be able to compete globally against foreign competitors. This allows these younger industries to grow a competitive advantage to compete on the global stage. And the last reason I'm going to bring up is retaliation, and this brings about a lot of fears. Countries may increase trade barriers if they don't believe trading practices with a partner country are fair, which can escalate to a trade war scenario. So who ultimately are the winners and losers when it comes to trade barriers being implemented? Well, ultimately, the winners in terms of trade barriers are the domestic producers. Tariffs generally increase the price of goods from abroad, and quotas limit the amount of goods being able to be shipped in from abroad, which can affect the supply of a good and the price of a good. This allows domestic producers to increase their domestic market share of a good and also their profitability through margin expansion. So who are the losers when trade barriers are implemented? Well, producers abroad are, when tariffs are levied, producers will have to either lower their prices to compete with those domestic producers, or if they keep prices higher, they'll lose out on supply to domestic producers. And also, domestic consumers are a loser when it comes to trade barriers. Usually, the tariffs get passed on to the consumers in terms of higher prices, which definitely impacts what consumers can afford. So I just want to cover a little bit in terms of how the US has utilized tariffs in the past. Tariffs were the primary source of revenue for the federal government until the early 1900s. We've relied on tariffs being our primary source of revenue up to 95% until the federal income tax was implemented in 1913. Protectionist policies were adopted as soon as the first US Secretary of the Treasury, Alexander Hamilton, was appointed in the late 1700s. The overall level of tariffs throughout most of the 1800s were very, very high, up to 60%. And just to give you an idea of how protectionist the ideologies of some of our former presidents are, I wanted to read you a couple of quotes. This quote is from Abraham Lincoln from 1844. "Give us a protective tariff and we will have the greatest nation on earth." Teddy Roosevelt also said in his State of the Union in 1902, "Our past experience shows that great prosperity in this country has always come under a protective tariff." These are very strong words. It really wasn't until 1934, in an effort to reverse the fallout from the highly protectionist Smoot-Hawley Act that many economists believe exacerbated the Great Depression, that the US started moving towards a strong trend of lowering tariffs and fostering free trade policies. I wanted to point out in this graph that the light brown line is the average tariff levied against dutiable imports, which, if you think about tariffs, most oftentimes they are not implemented across every single good, but a selection of goods. And so that is the average tariff assessed to those goods that were assessed a tariff. And the darker brown line is all goods. So you can see over time that there can be a discrepancy between the amount of goods that are being assessed a tariff. And I want to highlight, you can see the number 59 there. That is Smoot-Hawley. And you can see from that point on, we've really moved towards freer trade policies and lower tariffs. If we look at the last couple of decades, we've seen tremendous advancements in terms of global trade growth. And this has come from the establishment of the European Union, the NAFTA negotiations with the US, Mexico, and Canada, China joining the World Trade Organization, the implementation of the euro as a single currency. But over the last couple of years, we've started to see global trade start to compress just slightly. And I want to talk about more recently what's been going on in the news. So just this year, we've seen a string of potential changes in trade policy, and it's led to considerable volatility in the market. It seems like whenever a new trade policy announcement is made, the market really starts to fall apart. Well, I want to talk about two of the largest announcements in terms of what impact we think they'll have on economic fundamentals. On this chart, I'm referring to the news of Trump tariffs, which are effectively the steel and aluminum tariffs, as well as the China tariffs. So let's first cover the steel and aluminum tariffs. Our administration announced tariffs on steel of 25% and tariffs on aluminum of 10%. And if we actually look at the major exporters of steel and aluminum to our country, a couple of the largest exporters are really Canada and Mexico. And at this time, these are both exempt from this current round of tariffs pending future negotiations. This really affects Russia, Japan, and China, but these commodities are a very small percentage of the overall goods that they export to the US. So ultimately, at this point, we think the economic impact from the steel and aluminum tariffs will be muted. Additionally, the second important string of announcements were targeted tariffs against imported Chinese goods. The US outlined at first a tariff that would affect 50 billion in Chinese goods that would be taxed at a rate of 25%. And then we saw an additional announcement that would tax a further 100 billion of Chinese goods. It's important, though, to put these tariffs in the context to the US, Chinese, and global economy. As we look at this chart, Chinese exports to the US make up less than 0.8% of global GDP. And if we further dive in and look at the size of the goods potentially being impacted, 50 billion of goods only makes up 0.1% of China's GDP and 0.06% of US GDP. So even with the additional potential 100 billion in potential goods affected, we're still looking at a relatively small percentage of both economies being affected by these tariffs. If we also compare the potential tariffs to all of the fiscal stimulus that we've seen over the past year, looking at the steel 232 tariffs, which cover the aluminum and steel tariffs, the China 301 retaliation of 12.5 billion and 25 billion, which are targeted at the Chinese imports, you'll see on the right-hand side, between tax cuts, spending, and repatriation of cash, significantly dwarfs any impacts we might see from the tariffs. So why do we see such a disconnect between how the market is reacting and what we estimate are the fundamental economic impacts? Well, it really comes down to rising uncertainty around an escalation of trade barriers. As we see from the chart on the right, just the mention of tariffs on earnings calls has significantly picked up in the first quarter of this year. Large multinational companies have very complicated supply chains that span the globe. And with uncertainty around where future tariffs or other types of trade barriers might be implemented, it is very difficult for them to make capital investment decisions around spending on new projects or hiring additional staff. We also have a tremendous amount of trade negotiations in play right now. Between Brexit, we have the EU and the UK, the US and the UK. We're renegotiating NAFTA between the US, Canada, and Mexico. We also have negotiations with the US and Japan, and the US is also considering joining the Trans-Pacific Partnership. And what we really think is the biggest risk is between the negotiations of the US and China. So why is the US so focused on China? China is very quickly moving up the supply value chain and often capturing market share from developed economies such as Japan, Germany, and the US. China has made announced goals of becoming a global leader in areas such as aircraft, 5G, integrated circuits, and electric vehicles. And you can see from the chart on the right that China has quickly risen in terms of exports that are global research intensive and now has surpassed Germany, US, and Japan. China has also been cited as an alleged contributor to direct losses to the US of between $250 and $600 billion annually due to counterfeit goods, patent theft, and theft of trade secrets, according to a 2017 IP Commission report. China is also responsible for one of the most restrictive foreign direct investment regimes and ranks alongside Saudi Arabia. I also want to take a look at the tariff reciprocity. And what this gets at is the tariff relations between the US and foreign countries. If you look at the chart, along the bottom you see this is the average tariff that the US pays to export their goods to other countries. And along the left you'll see this is the average tariff that foreign countries pay to import their goods into the US. The reciprocity line would be that if countries are paying the same percentage of tariffs to import their goods as to export their goods. And you can see that there are not very many countries that hit this reciprocity line. So if any countries are to the left of the reciprocity line, that means that the US has more advantageous tariff agreements than they have importing their goods into the country. And the only countries that I can see are really Chile, Australia, and Mexico. I do want to highlight the red diamond, China. You can see that the average tariff that the US pays to China is nearly 11%, whereas goods imported into the US from China pay an average tariff of a little under 4%. I think this leaves a lot of room for negotiations as we work through future trade policy negotiations over the coming years. So what are the US trade goals with China? Well, it's to open the Chinese market to further foreign direct investment. It's making China enforce intellectual property protection and also stopping China from forced technology transfers. So I want to talk a little bit, because this is such a big risk in terms of escalating trade war, how intertwined our two economies are. Although there are risks in terms of an escalation, we really think that our two economies are very symbiotic. First, China ships low-cost goods to the US, benefiting both Chinese exporters and US consumers. The US then pays for those goods in US dollars, and China reinvests those proceeds back into the US market by buying US treasuries and other debt. This has really helped keep interest rates low in the US and has benefited China in terms of investment into their exporters. So what happens when this symbiotic relationship, this cycle, starts to fall apart? Well, if we implement tariffs in number one, all of a sudden those low price goods are no longer low priced anymore, and they are less likely to compete with other goods within our country. So US consumers are going to be buying less goods, and most likely those prices are going to rise. That hurts Chinese exporters as well as US consumers. China will not be investing nearly as many US dollars into the US market, which means they will not be buying nearly as many treasuries. And as Howard had mentioned before, in 2019 alone, the US Treasury is expected to issue up to $3 trillion in US treasuries. This is a very big concern for investors. Investors are very concerned that China may not be buying nearly as many US treasuries, and they might actually be selling some of those treasuries into the market, which could lead to a cycle of higher and higher rates in the US, which may end up leading to a recession. Well, one of the reasons why I don't think that the Chinese government will be selling treasuries is they already have nearly $1.2 trillion of US treasuries on their balance sheet. If they begin to sell those treasuries into the market, that's going to put pressure on US rates to rise, which is directly going to impact the assets, that 1.2 trillion that they have on their balance sheet, and they'll have to mark those treasuries to market, which could have a great impact on their reserves. So between the impacts to the US consumer, to Chinese exporters, and the fact that China already holds 1.2 trillion in US debt, we think that the risks in terms of an escalating trade war are muted. And although we see that this escalating trade war is muted, I did want to highlight a couple of areas within the portfolio that should be relatively insulated from an escalating trade war scenario. The first one I want to point out is emerging market equities. Emerging markets beyond China should be relatively insulated from an escalation of trade barriers between the US and China. Most emerging market countries have strong domestic demand and have little export exposure to the US. Another area within the portfolio are US small and mid-cap companies. They typically have less foreign exposure in terms of revenues. As an example, 80% of revenues in the Russell 2000 are generated domestically. And an escalating trade war actually might benefit these companies, as I talked about in terms of the winners and losers in escalating trade barriers earlier. Another area that will hold up relatively well in terms of an escalating trade war are uncorrelated strategies such as reinsurance and long-short factor strategies. In conclusion, we do see a disconnect between the market's reaction to the US currently proposed trade policy changes and its estimated impact on economic fundamentals. We think that the market is ultimately concerned over an escalation of trade barriers that would significantly impact global trade and growth, but believe the risk of a dramatic change in global trade policy is relatively low. Although a trade war is unlikely, I have highlighted a few areas within portfolios that we believe are relatively insulated from escalating protectionism. Thank you very much, and at this time, I'll turn it over to Howard.
Thank you, Brander. In conclusion, I hope you have an understanding of why the first quarter was as volatile as it was. On the positive side, we have excellent fundamentals. In corporate earnings, in economic data, but we have these large macro overhangs, and especially trade, as Brander explained. And that was really the message that we were trying to get across today, is that explanation of what's happening in the markets and why we still are relatively optimistic about US markets. With that, thank you very much. There have been a couple questions. We've been 45 minutes, however, so my apologies. Please discuss your questions with your relationship manager, portfolio manager. We will see you next quarter. Thank you very much.